Partners, which is a 501c3 nonprofit. And we are kind of a special type of nonprofit. We're known as a community development financial institution. And like everything in the world, it has an acronym, CDFI. There are not a lot of CDFIs throughout the nation. And so we're a bit unique in how we handle things. We provide affordable housing, and that's really become my passion. I come from a lending background, but never really knew much about affordable housing, but I've really learned a lot in the past few years being in affordable housing. I serve on my small town where I live in local Colorado on the city's Affordable Housing Commission, and hopefully in my community I'm making changes personally that will assist low-income families to purchase in Colorado. Funding Partners does more than one type of financing. We have a project financing mechanism. Our executive handles short-term gap financing for developers who are building affordable housing. And everything we do is just limited to Colorado. And then I'm the chief cook and bottle washer for all residential assistance programs. So I wear a lot of different hats at Funding Partners. And this past year, I've kind of taken a little bit of a hiatus from promoting the employer-assisted housing, and I've instead been involved in the National Stabilization Program, some of the federal funding that came out for that, as well as being the Colorado coordinator for the National Community Stabilization Trust. So us in housing have been kind of in the crisis mode the last few years and trying to stabilize what's happening in our communities. But I've learned a lot, and I've met a lot of great people who really care about helping people and doing affordable housing. So it's been a great learning curve for me, but 2011 I'm going to focus more on my affordable housing in the resort areas, which is where most of our down payment assistance programs are. We do contract servicing for about 23 different entities in Colorado, but 13 of them, so the majority of them are employers. And like Diane, we also do a lot of municipalities. So I'm located about 60 miles north of Denver, which is known as the Front Range of Colorado. And while it's expensive to live there, it's really expensive to live in Vail or Aspen or Steamboat Springs. So all of these resort communities have a very specialized housing problem, probably very much like what they're facing here in Hawaii. You know, a 1 or 2 bedroom condo, $350,000, and single-family homes, like they probably are in Hawaii, are just really out of most people's reach, even people that make fairly good incomes. So that's really been our focus, and along the Front Range, it's expensive, but people can still afford them, housing there. So we do not have nearly the volume that Diane's bank has, but we have done about $2.5 million in production for our employer-assisted housing programs. Our loan amounts vary from a couple $1,000s all the way up to $80,000. If you were an employee in the town of Vail, they'll gladly loan you $80,000 to buy that very expensive home. So our average loan is a bit skewed by some of those really high numbers, so it's about $24,000. We do not do any of the grants or the interest buy-downs like Michael was speaking about. Everything is subordinate, second liens. We have several different structure options that we offer. We do the monthly payment loans for some of our organizations. That seems to be the least favorable because these people are barely qualifying oftentimes, and that additional monthly payment can kind of push those debt-to-income ratios over the maximums. We do have employers that provide forgivable loans. First National Bank along the Front Range is one of our clients, and if you stay with the bank for 5 years, your loan will be completely forgiven. So they forgive on a 20% per year. So at the end of 5 years, it's 100% forgiven. They were actually our very first employer that we started working with. And they did a study, and this has been probably 5 years ago, that just for bank tellers, so, that's not a real high-paying job, but they were hiring and training their own competition. They were hiring and training bank tellers, and then, like Michael mentioned, 2 to 5 years, they're gone. They're off to some other bank that had, better benefits or a little higher pay. So they really wanted to retain those employees, and they did a little study just within their own bank that they figured that losing a teller or a personal banker cost them about $7,000. So they decided, let's take those funds and let's start a down payment assistance program. So they have been our longest and most valuable employer that we administer loans for, and the 100% forgivable loan has worked out very, very well from them. They are such a great bank that it's been probably close to 2 years ago, they did have to lay off some people, and they continue to forgive those loans on a yearly basis, even though those employees were no longer with the bank. So they are really one of the front runners in our area for providing down payment assistance. A statistic that I would like to tell you about that I think we're very proud of is that of the $2.5 million in loan production that we've done, we have had no foreclosures. And that's a great statistic. We administer other types of down payment assistance programs that are not through employers, and we've had quite a few foreclosures in some of those other programs in certain areas down in the Denver area that were very, very hard hit by foreclosure. But something about the employer loaning you the money to buy that house, you're gonna make that house payment. So that's been a really good statistic and helps us to add additional employers. One of the things in the little handout, and this kind of speaks to Michael's great story of inspiration, I love this little card that's in here. Will he earn enough to live in your community? I think putting a face, instead of just, area median income, median home prices, those are all just statistics, but really putting this gentleman's face, or, the workers that you're speaking to the employer about, is just really invaluable. It's partnerships, it's leveraging, but I think really showing, especially some of the upper management, or if you're dealing with the municipality, the Board of County Commissioners, or City Council, whoever that may be, for them to really think about what it's like, other than just numbers and statistics, for these people, like the police officers, who are out there putting their life on the line every day, and can't afford to buy a home or stay in their home. So I think that's a really important thing, and because we're kind of a smaller organization, I think we have done a good job of getting out there. And I have a smaller Colorado's not a small state, but I don't have to deal in multi-states to promote these products. And like Diane's group, we do the same thing. We customize each program for each employer. Try not to reinvent the wheel. If there are models out there that are working, let's stick with those. We do a lot with the equity sharing model, which I know one of the speakers this morning from the Hawaii, I don't know. In Colorado, we call it CHAFA, so the Housing and Finance Authority. I'm sure you guys have a nickname for it here in Hawaii, too. So that's, totally lost my train of thought there. I'm asking you guys if you're staying awake. I don't know where I was going with that. Anyway, shared appreciation, thank you. So that's a really great model because there are no monthly payments associated with it. We call it a pro rata share of the appreciation. So most of our loan amounts are based on a percentage of the purchase price. So if they're borrowing 5% of the purchase price, then when they pay off their down payment assistance loan, they're sharing 5% of the equity. It's fairly straightforward, easy to explain without that additional monthly payment. It makes them qualify for a little bit larger mortgage. And statistically, most people only keep their mortgages, it used to be about 5 to 7 years. I don't know if that's increased now in the last few years, but those are 15-year balloon programs. So usually within 15 years, they've done something. They've sold or refinanced or done something to pay that off. So that balloon term can be kind of intimidating for people, but if you kind of explain it properly, I think that that's a good model. So we encourage our employers to go with that type of a model, but again, they're welcome to do anything that they want to do as long as it conforms to the first mortgage financing and secondary market. It's no use in having a down payment assistance program that you can't get first mortgage financing in front of. Funding Partners has a unique ability because we are one of the few organizations in Colorado that handle this type of financing. We're kind of a one-stop shop for a lot of buyers who want to get down payment assistance. Oftentimes, the employer-assisted down payment assistance program can be in second lien position, and depending on where they're geographically located, I might have 1 or 2 more down payment assistance programs that could go in behind that. So I do see third and sometimes even fourth liens. So that leveraging really assists these home buyers in these very, very high-cost areas to get a mortgage payment that they can afford. Talking a little bit about the challenges, you know, we face the same sort of challenges that Diane and Michael have, that, you know, it's been a tough economy for everyone, including employers and municipalities and governments. You know, they're cutting their budgets, and we do find that even in this tough economy, the existing employers that we have are refunding, not refund, but they're adding additional funds to their programs because they really see the value of what that employer retention and employee loyalty does. You know, the success stories that I hear after closing are very heartwarming, and the employers, they see the value in that. So it's a little bit hard to get them started. It's fairly easy for them to see the value and to keep funding the program once it's started. We don't have a lot of luck in the public sector, or I'm sorry, the private sector. Most of our programs are either government entities or banks, or some of the organizations are what's considered quasi-municipal. So again, you know, ambulance drivers, firemen, things like that. We have a wonderful website if you're ever interested in learning more about the different programs, fundingpartners.org, and all of our programs, as well as the guidelines and the closing documents, are all on these websites. So please contact me if you have any questions or need any assistance in learning more about these programs. We're a nonprofit, we're not really competing against anybody, so we're very transparent with all of our information, and I'm happy to help in any way I can. So again, thank you for inviting me, and I really appreciate it.